Just hours ago, a major global event sent shockwaves through the gold, oil, and currency markets. And what happened next surprised many investors. Oil prices dropped sharply. Geopolitical tensions appeared to cool. Many traders expected gold prices to fall because gold is usually considered a safe haven asset during times of uncertainty. But instead, gold moved higher. And that raises one of the biggest questions in today's market. Why is gold rising when one of the major risks facing global markets appears to be decreasing? Is the market looking beyond today's headlines? Is smart money preparing for something bigger? Or is this simply a short-term move before another major correction? If you own gold, silver, stocks, or even US dollars, the next few weeks could reveal important clues about where global markets are heading. Because markets don't move based on one single piece of news, they move based on expectations. They move based on fear. They move based on what investors believe will happen next. And today, we are going to break down exactly what is happening. We will analyze the latest Reuters report, explain why oil prices dropped, why gold moved higher, how the US dollar is affecting precious metals, what the Federal Reserve could do next, and what this could mean for investors around the world. So let's get started. According to Reuters, 3 major developments immediately changed the mood in global financial markets. The first involved tensions between the United States and Iran. The second involved a sharp move lower in oil prices. And the third involved a surprising reaction from gold. Let's start with what happened in the Middle East. Fighting between the United States and Iran has temporarily paused. Whenever tensions rise in this region, markets immediately focus on one major question. What happens to global energy supplies? The Middle East remains one of the most important regions for global oil production and transportation. Any major disruption can create fear that oil supplies could become limited, and when investors fear a shortage of oil, prices usually move higher. But when tensions appear to cool, the market starts thinking differently. Investors begin believing that the risk of supply disruption has decreased. That can create selling pressure in oil markets, and that is exactly what we saw. Oil prices dropped sharply, falling more than 4% in a single trading session. For commodity markets, this is a major move. But why does oil matter so much? Because oil is directly connected to inflation. Almost everything in the global economy depends on energy. Trucks need fuel. Ships need fuel. Factories need electricity and energy. Businesses need transportation. When oil prices rise, companies often face higher costs. And many times, those costs eventually reach consumers through higher prices. This creates inflation pressure. But when oil prices fall, the opposite can happen. Transportation costs can decrease, production expenses can become lower, companies may face less pressure from rising input costs. And this changes what investors expect from central banks, especially the Federal Reserve, because inflation remains one of the biggest factors influencing interest rate decisions. But now comes the most interesting part of this story. Despite falling oil prices, despite easing geopolitical tensions, gold moved higher. And at first glance, this seems confusing. Many investors think, if the world becomes safer, why would people buy gold? But professional investors look at the bigger picture. Gold does not only move because of wars or crises. Gold responds to multiple forces. It reacts to currency movements. It reacts to interest rates. It reacts to inflation expectations. It reacts to central bank demand. It reacts to investor confidence. And one important factor supporting gold was the movement of the US dollar. The dollar weakened slightly. Since gold is priced globally in US dollars, a weaker dollar can make gold cheaper for international buyers. When gold becomes cheaper in other currencies, demand can increase. And this is why understanding gold requires looking beyond a single headline. Now let's look at the 3 biggest reasons gold continues to attract investor attention. The first major factor is the relationship between gold and the US dollar. Historically, gold and the dollar have often moved in opposite directions. When the dollar weakens, gold often becomes more attractive. Why? Because gold is priced internationally in dollars. Imagine an investor outside the United States. If the dollar becomes weaker compared to their local currency, purchasing gold becomes relatively easier. That can increase demand. This is why many professional investors closely watch the dollar index. A major move in the dollar can create significant moves in gold. However, investors should remember something important. This relationship is not perfect. There are times when both gold and the dollar can rise together because investors are reacting to different risks. Markets are complex. There is never only one reason behind a price movement. The second major factor is the Federal Reserve. Right now, investors around the world are watching every statement from the Fed, and there is a very good reason for that. Interest rates have a huge impact on gold. Gold is different from stocks and bonds. Gold does not pay dividends. Gold does not generate interest income. So when interest rates are high, investors may prefer assets that provide returns. For example, if investors can earn attractive returns from government bonds, some money may move away from gold. But if interest rates begin falling, the opportunity cost of holding gold becomes lower. That can make gold more attractive. This is why every Federal Reserve meeting matters. Sometimes one sentence from policymakers can completely change market expectations. The third major factor is geopolitical uncertainty. Even though tensions have temporarily eased, the bigger risks have not completely disappeared. Markets understand that a temporary pause does not always mean a permanent solution. Geopolitical situations can change quickly. One unexpected event can bring fear back into financial markets. And when uncertainty rises, investors often look for assets that can protect wealth. Historically, gold has played that role. For thousands of years, gold has been considered a store of value. Governments hold it, central banks hold it, large institutions hold it, and during uncertain times, demand for gold often increases. Now let's talk about another important asset that often moves alongside gold: silver. Many investors look at silver as simply a cheaper alternative to gold, but silver is actually very different. Silver has a unique position because it is both a precious metal and an industrial commodity. Gold is mainly influenced by investment demand, central bank purchases, inflation concerns, and global uncertainty. Silver, however, has another major driver: industrial demand. Silver is used in many industries that are becoming increasingly important in the modern economy. It is used in solar panels, it is used in electronics, it is used in electric vehicles, it is used in medical technology and advanced manufacturing. This means silver can benefit from two different sources of demand. The first is investor demand. When investors become interested in precious metals, silver often receives buying pressure. The second is industrial demand. When global manufacturing grows, demand for silver can increase because companies need it for production. Historically, during strong precious metal cycles, silver has sometimes moved faster than gold. The reason is simple. The silver market is much smaller, which means large movements in demand can create bigger percentage changes. But investors should also understand the other side of silver. Higher potential returns usually come with higher volatility. Silver can rise quickly, but it can also experience sharp declines. That is why investors need to understand their risk before making decisions. Now, one thing separates experienced investors from beginners. Beginners usually focus on the headline. They see, gold is rising, oil is crashing, markets are moving, and they immediately react. But professional investors ask different questions. They ask, why is this happening? Is this move temporary or part of a larger trend? What factors could continue driving this market, and what risks could reverse the move? This is how smart money thinks. They are not trying to predict every single price movement. Instead, they focus on the bigger picture. And right now, there are several important trends that investors are watching closely. One of the biggest factors is Federal Reserve policy. The Federal Reserve controls interest rate decisions in the United States, and those decisions influence almost every major financial market. Interest rates affect stocks, they affect bonds, they affect currencies, and they strongly influence gold. If the Federal Reserve becomes more supportive of lower interest rates in the future, that could create additional support for gold. Why? Because when interest rates fall, investors may become less interested in assets that provide fixed returns and may look more toward alternative stores of value. However, if inflation remains high and the Federal Reserve decides to keep interest rates elevated for longer, gold could face short-term pressure. This is why investors are not only watching what the Fed does, they are watching what the Fed says, because market expectations often move prices before actual decisions happen. Another major factor is the US dollar. The dollar remains the most important currency in global finance. When investors are worried about the economy, they often move toward the dollar because it is considered one of the world's most liquid and trusted currencies. But when confidence in the dollar weakens, some investors look for alternatives, and historically, gold has been one of those alternatives. This is why the relationship between gold and the dollar remains one of the most important things to understand. A stronger dollar can create pressure on gold. A weaker dollar can provide support. But again, markets are never controlled by one single factor. Multiple forces are always working together. Another major trend supporting gold is central bank buying. Central banks around the world hold gold as part of their reserves. They do this because gold is different from traditional currencies. Gold is not controlled by one government. It cannot simply be created through monetary policy. And throughout history, gold has maintained value through different economic cycles. During periods of uncertainty, some central banks increase their gold holdings because they want to diversify their reserves. This long-term demand creates another layer of support for the gold market. But there is another important issue investors cannot ignore: global debt. Governments around the world are carrying historically high levels of debt. High debt levels do not automatically mean a financial crisis is coming, but they do create concerns about the future. Investors start asking questions. How will governments manage this debt? Will currencies lose purchasing power? Could inflation return? Could economic uncertainty increase? These questions are one reason some investors continue to hold gold. Gold has survived thousands of years of economic changes. It has survived wars. It has survived currency changes. It has survived financial crises. That history is one reason people continue viewing gold as a form of financial protection. Now, the biggest question: where could gold go from here? The reality is that nobody knows the exact future. Anyone who claims they know the exact price of gold tomorrow is making a prediction, not a fact. Successful investors do not try to predict every move. They analyze probabilities. They look at different scenarios. So let's look at what could happen next. If the dollar continues weakening, if interest rate expectations become more supportive, if central banks continue buying gold, and if geopolitical uncertainty returns, gold could continue attracting investor interest. In that environment, many analysts believe gold could continue challenging higher price levels over time. However, investors also need to understand the risks. Markets do not move in a straight line. Even strong assets experience corrections. Gold can have days or weeks where prices fall. A temporary decline does not automatically mean the long-term trend has changed. If the dollar becomes stronger, if interest rates remain high for longer, or if investors become more confident in risk assets like stocks, gold could experience a pullback, and that is completely normal. Every market goes through cycles: periods of excitement, periods of fear, periods of correction, and periods of recovery. The key is having a plan before emotions take control. Because one of the biggest mistakes investors make is buying when prices are already rising because of fear of missing out, and then selling when prices fall because of fear. Successful investors try to do the opposite. They stay informed, they stay patient, and they understand why they own an asset. So as we move forward, there are several things every investor should watch. Watch the Federal Reserve, watch the US dollar, watch inflation data, watch oil prices, watch geopolitical developments, and watch central bank activity. These factors together will tell a much clearer story than any single news headline. Because the market is not just reacting to what happened today, it is trying to predict what happens next. And right now, gold is showing investors something important. Even when one risk decreases, uncertainty can still remain. That is why gold continues to attract attention from individual investors, institutions, and governments around the world. Now, after understanding all these factors, let's talk about the bigger picture. Because the biggest mistake investors make is focusing only on today's price movement. They see gold moving higher and immediately ask, how high can it go? But the better question is, what forces are creating this move, and can those forces continue? That is the question professional investors ask. Right now, gold is being influenced by several powerful forces happening at the same time: a changing interest rate environment, currency uncertainty, central bank demand, geopolitical risks, and concerns about the future of the global economy. When multiple factors point in the same direction, major market moves can happen. But investors should also remember something important. Nothing moves upward forever. Even the strongest markets experience periods of profit-taking and corrections. A correction does not always mean the story is over. Sometimes corrections are simply the market taking a pause before the next major move. This is why investors need to separate short-term noise from long-term trends. A one-day move in gold does not define the future. A single headline does not define the entire market. The real question is whether the underlying reasons behind the move are still present. And right now, investors are watching whether these major themes continue. Will central banks continue adding gold to their reserves? Will the dollar continue losing strength? Will interest rate expectations change? Will geopolitical risks increase again? These questions will determine where gold moves next. Let's look at a few possible scenarios. If we enter a situation where inflation remains a concern, interest rates begin moving lower, and investors become more cautious about economic conditions, gold could receive additional support. In this environment, demand for precious metals could remain strong. Investors searching for protection may continue looking toward gold. However, there is another possibility. If inflation falls faster than expected, the economy remains strong, the Federal Reserve keeps rates higher for longer, and the dollar strengthens, gold could face pressure. This does not mean gold's long-term story disappears. It simply means markets move through different phases. Every asset has periods of strength and weakness. The smartest investors prepare for both possibilities. They don't only think about what can go right, they also think about what can go wrong. This mindset is what separates investing from gambling. Gambling is based on hope. Investing is based on understanding risk and reward. So if you are currently holding gold, what should you focus on? First, understand your reason for owning it. Are you holding gold as a short-term trade? Are you using it as protection against uncertainty? Are you building long-term wealth? Your strategy should match your goal. Second, avoid making emotional decisions. When gold rises quickly, many people rush in because they fear missing the opportunity. When gold falls, many people panic and sell. But successful investors understand that emotions are often the enemy of good decisions. The market rewards patience. The market rewards preparation. And the market rewards people who understand what they own. Another important point is diversification. Gold can play an important role in a portfolio, but putting everything into one asset creates its own risks. A balanced approach is usually more effective. Different assets perform differently in different economic environments. Stocks, bonds, cash, real estate, and precious metals all have different roles. The goal is not to find one perfect investment. The goal is to build a strategy that can survive different market conditions. Now let's come back to today's news. The reason this event matters is not just because gold moved higher. The real story is what the market reaction tells us. Investors are still paying close attention to uncertainty. They are still watching the dollar, they are still watching interest rates, they are still thinking about the future. The market is telling us that even when one risk decreases, investors are still searching for protection. And that is why gold remains one of the most closely watched assets in the world. For thousands of years, gold has represented stability. It has been used as money. It has been held by kings, governments, institutions, and investors. And even in today's modern financial system, gold continues to play an important role. Not because it is perfect, not because it always goes up, but because it provides something unique. It is an asset outside the traditional financial system, and during periods of uncertainty, that difference becomes extremely valuable. So what happens next? The next few weeks could be very important. Investors will be watching Federal Reserve decisions. They will be watching inflation numbers, they will be watching the dollar, they will be watching oil prices, and they will be watching global events. Any major change in these areas could create the next big move in gold and silver. The biggest lesson from today's market action is this: do not just watch the price. Understand the story behind the price. Because prices move based on expectations. They move based on psychology. They move based on what millions of investors believe will happen next. And right now, the story of gold is about much more than just one day's movement. It is about currencies. It is about interest rates. It is about global uncertainty. And it is about how investors protect their wealth during changing economic conditions. So now I want to hear your opinion. Do you think gold is entering another major move higher? Or do you think we could see a correction before the next rally? Are you currently holding gold? Are you investing in silver? Or do you prefer assets like stocks and the US dollar? Let me know your thoughts in the comments below. If you found this analysis valuable, make sure to like this video and subscribe to the channel. Turn on notifications because we will continue covering the biggest moves in gold, silver, currencies, and global financial markets. Remember, successful investing is not about chasing every headline. It is about understanding the forces behind the market. It is about staying patient. It is about making decisions based on knowledge instead of emotion. Thank you for watching. I will see you in the next video.